What are the risks and consequences of a U.S. debt bubble burst? A debt bubble is a situation where the total amount of debt in an economy grows faster than the income and output that can support it. When the debt becomes unsustainable, it can burst, leading to a sharp contraction in economic activity and financial markets. One of the main risks of a U.S. debt bubble burst is that it could trigger a financial crisis. A financial crisis occurs when banks and other financial institutions face liquidity or solvency problems and are unable to lend or borrow money. This can cause a credit crunch, where businesses and consumers have difficulty accessing credit, and a panic, where investors lose confidence and withdraw their funds from the financial system. A financial crisis can also spread across borders, affecting other countries that are exposed to the U.S. economy or financial markets. Another risk of a U.S. debt bubble burst is that it could cause a recession. A recession is a period of negative economic growth, usually lasting at least 2 consecutive quarters. A recession can result from a decline in consumer spending, business investment, government spending, or net exports. A recession can also lead to higher unemployment, lower incomes, reduced tax revenues, and increased budget deficits. A third risk of a U.S. debt bubble burst is that it could lead to a collapse in asset prices. Asset prices are the values of stocks, bonds, real estate, commodities, and other assets that people own or trade. Asset prices can be affected by supply and demand factors, as well as by expectations and sentiments of investors. A debt bubble burst can cause asset prices to fall sharply, as investors try to sell their assets to repay their debts or avoid losses. A collapse in asset prices can also reduce the wealth and net worth of households and businesses, and lower their spending and borrowing capacity. A fourth risk of a U.S. debt bubble burst is that it could result in a loss of retirement savings for millions of Americans. Retirement savings are the funds that people accumulate during their working years to support their living expenses after they retire. Retirement savings can be held in various forms, such as pensions, 401k plans, individual retirement accounts, IRAs, or Social Security benefits. A debt bubble burst can erode retirement savings by reducing the returns on investments, increasing the inflation rate, or cutting the benefits from Social Security or other programs. These are some of the potential risks and consequences of a U.S. debt bubble burst. As you can see, they are serious and far-reaching, and could affect not only the U.S. economy but also the global economy and financial system. In the next section, we will discuss some of the possible ways to prevent or mitigate a U.S. debt bubble burst.